When Wall Street sold miracles, one man sold math. John C. Bogle didn't promise to beat the market. He promised to give it back to humanists almost nothing. That quiet promise became a trillion-dollar rebellion. He grew up during the Great Depression, learned thrift like a native language, and entered finance with a heresy. Costs matter more than charisma. At Wellington, he rose fast, then fell hard after a bad merger, fired. Reputation dented. Most people would chase redemption with a louder gamble. Bogle chose something smaller, plainer, tougher. A new firm owned by its clients, not outside shareholders. He called it Vanguard. Then came the idea that made him infamous, before it made him legendary. An index fund. Not a genius picker, a mirror. Don't look for the needle, he'd say. Buy the haystack. In 1976, Vanguard launched the first index investment trust. The street laughed and nicknamed it Bogle's Folly. Why settle for average? Because the arithmetic of active management isn't opinion, it's gravity. Before costs, investors in aggregate are the market. After costs, the group must underperform the market by the amount of those costs. If you make fees tiny and behavior sane, you win by subtraction. Bogle waged war on the quiet killer expenses that compound against you. A 1% fee sounds small. Over decades, it eats like rust. Performance comes and goes. Cost is permanent. He built a company to trap that truth in its DNA. No external owners demanding profits, just investors who owned the funds that owned the firm. Client and owner became the same person. When Vanguard became more successful, expense ratios fell. Alignment wasn't a slogan, it was the structure. The case for indexing is disarmingly simple. The market's long-term return is a pie. Every extra hand that takes a slice, management fees, trading costs, taxes from needless turnover shrinks your piece. The index fund says, leave the pie alone. Own all the businesses, accept the market's return, and focus on the one lever you completely control. But Bogle never said buy an index and nap. He said, stay the course. That means pick a broad market index. Add a bond ballast appropriate for your nerves and timeline. Automate your contributions. Rebalance on a schedule. And ignore the carnival of predictions. You're not making a clever bet. You're building an efficient machine. He knew the enemies of that machine by name: greed, fear, and noise. Greed tempts you to chase last year's star. Fear pushes you to sell what just fell. Noise tells you both moves are urgent. Bogle's answer, orderly, unfashionable, was patience. Time is your friend, impulse is your enemy. Markets don't pay extra for excitement. Make this practical. If you can't explain a fund's strategy in one sentence, pass. If the expense ratio isn't near zero, pass. If turnover is high, taxes will be to pass. Your checklist is dull on purpose. Broad, low cost, tax efficient, rules based. The thrill shows up later, when compounding turns ordinary years into extraordinary outcomes. Bogle also respected behavior as much as spreadsheets. He urged investors to set an allocation they could live with in a storm because bear markets don't ask permission. A 70/30ths or 60/40ths stock bond mix won't impress at cocktail parties. It will help you sleep, keep you invested, and that matters more than any elegant model that collapses when your hands shake. Understand what indexing is not. It's not surrender, it's discipline. It's the decision to stop paying for the illusion of certainty. It's the humility to say, I will own the winners I can't predict, and the losers I can survive, at a cost I can control. And the revolution? Look around. The fund once mocked as folly became the default for retirement savers. Endowments and even pros who quietly index while they talk about themes. Fees across the industry collapsed because one firm made it impossible to keep them high. That pressure didn't just transfer wealth from Wall Street to Main Street. Changed how finance treats its customers. Here's your Bogle playbooks, simple enough to write on a note card. Own the whole market, a total market or S&P 500 index for stocks. A broad bond index for stability. Keep costs, microscopic expense ratios in the single basis point neighborhood. Automate. Contributions every month. Storm or sunshine. Rebalance once or twice a year. Mechanically. Stay the course. Headlines change. The math doesn't. If you already invest, audit your portfolio tonight. Circle anything with a fat fee, a flashy promise, or a strategy you can't explain. Replace complexity with clarity. Replace hope with arithmetic. Replace maybe with almost certainly. Bogle didn't try to outshout the market. He outlasted it. He built a bridge, sturdy enough for ordinary people to cross from speculation to ownership, from anxiety to enough. That's the Vanguard revolution. Not a secret, a standard. If this gave you steel for the next storm act, cut your costs. Simplify your lineup. Write your plan on one page and commit to it. And if you want more stories that turn noise into signal, subscribe and share this with someone who needs a steadier way forward. You don't need a guru, you need a compass. Costs low, broadly own. Stay the course. That's the way.